Mr. Warren Buffett is worth over $130 billion today, and though he didn't get there, but the methods we mention on this channel, namely investing in index funds and ETFs, he's made some incredible individual stock purchases in his 7 decades of investing. Companies like Apple, American Express, and Coca-Cola. So, how shocking was it when in this 2013 letter to Berkshire Hathaway investors, he noted that, upon his death, the trustees of his wife's inheritance were instructed to put 90% of her money into a very low-fee stock index fund and 10% into short-term government bonds. A simple two-fund portfolio? Now the question is, what was Warren Buffett thinking? And more importantly, is this actually an effective strategy? But first, if you're new to the channel and if you're returning, welcome to Master Wealth, where we learn how to build and master our wealth. Consider subscribing if you'd like to build wealth together. 2013 Berkshire Hathaway letter. Let's delve a bit deeper into the 2013 Berkshire letter. In the letter, Warren Buffett lays out the two-fund portfolio. He starts out by saying how he and his business partner, Charlie Munger, made studying business prospects a priority in their lives. And he goes on to say to the rest of us that if we were wise, we would conclude that we do not know enough about specific businesses to predict future earnings. It's a humbling message, but if a man worth over $130 billion is sharing his wisdom, I'm willing to listen. However, the next part of the letter bears good news for us, normal folks. He says that a typical investor like us doesn't need the stock-picking skill like him. In aggregate, the American business has done wonderfully over time and will continue to do so. In the 20th century, the Dow Jones Industrial Index started out at $66 and ended at $11,497. Warren Buffett believes the 21st century will witness further substantial gains. Therefore, this is the important part. He goes on to say, the goal of the non-professional should not be to pick winners. Neither he nor his helpers can do that, but should rather be to own a cross-section of businesses that in aggregate are bound to do well. A low-cost S&P 500 index fund will achieve this goal. Warren Buffett. Warren Buffett then goes on to recommend the two-fund portfolio, not just for average individual investors like you and I, but also in instruction to his trustee. 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I love how he specifically recommends Vanguard. For the specific fund, this would translate to Vanguard's S&P 500 Index Fund, the VFIAX, and the Vanguard Short-Term Treasury Index Fund, the VSBSX. And he ends this section by saying he believes the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. Again, I want to emphasize the significance of this statement. Warren Buffett made his living by picking stocks, ones that made him a billionaire today. Yet, following his death, he recommends an index fund strategy, and a simple two-fund strategy at that. It almost feels like a man who made his living racing horses his whole life saying to his kids, "Don't worry about horses. You should get an electric car instead." And Warren Buffett isn't the only one that touts the simple two-fund strategy. J.L. Collins' two-fund portfolio. J.L. Collins, one of our favorite authors who wrote The Simple Path to Wealth, also recommends a simple two-fund strategy. His recommendation is slightly different in specific fund, but the general concept is pretty much the same. He recommends a total market index fund. A Vanguard-specific fund would be Vanguard Total Stock Market Index Fund, the VTSAX. And for bonds, he recommends Vanguard Total Bond Market Index Fund, VBTLX. and he breaks down his recommendation by phases in life. When you are in your wealth accumulation phase, when you're still investing into the market, he recommends 100% in stocks, VTSAX. He believes that you should be aggressive in your wealth accumulation phase, and I personally agree. You have time on your side, and because you are in the accumulation phase, the market ups and downs don't matter. And when you are in the wealth preservation phase, when you're living off investments, he allocates his funds to 75% stocks and the rest in bonds and cash. So the question is this: is a two-fund portfolio a sound investment approach? Is it something you and I could follow? And the simple answer is yes. Let me give you a few reasons why this simple index fund investing strategy is so effective. Number one reason, and Warren Buffett nailed this on the head, is that we can't pick winning stocks. Warren Buffett and Charlie Munger made a profession out of researching and identifying undervalued companies. And to their own admittance, they've made mistakes as well. People forget that Warren Buffett lost $3.5 billion on Dexter's shoes, and he admits that it was the worst deal that he ever made. But through these mistakes, Warren Buffett honed his stock-picking skills over a period of 7 decades, and thus made himself a household name. I think we should check our ego if we think we could pick stocks like Warren Buffett. The harsh truth is that I can't pick winning individual stocks or mutual funds, and neither can you, nor can the vast majority of people who claim they did or can. If you happen to be one in a billion who can, I'm not sure why you're watching this video. It is ridiculously difficult, and having the humility to accept this will be the key to making you rich and wealthy. Jokes aside, it is possible to win in the stock picking game, but it is an entirely different skills which you can master if you dedicate enough time to learning and failing forward. However, most of us don't have that time and resources to accomplish it, as it's a job in itself. Index investing is powerful because, despite our lack of stock-picking skills, we can still amass quite a bit of wealth by harnessing the power of equities market. Another reason why a simple two-fund index fund strategy is so effective that most people pay to receive higher returns than the stock market, such as through financial advisors and fund managers, and more often than not, they just can't beat stock market returns. When we talk about stock market, we're most often referring to what is known as the Standard & Poor's 500, or simply the S&P 500. The S&P 500 is an index of the 500 largest companies on the American stock market. It includes major companies such as Apple, Google, Coca-Cola, McDonald's, including hundreds of other large to small companies. Since 1980, the S&P 500 has delivered an annual average of over 7%. So, in order to beat the market, a financial advisor would need to design a portfolio that surpasses this number. This is not easy. The financial advisor must be skilled at designating the right investments, diversifying, and keeping up with the market trends, a tall order for anyone. Very few financial advisors have the skill and knowledge necessary to beat an index fund. According to a 2020 SPIVA report, over a 15-year period, nearly 90% of actively managed investment funds failed to beat the market. The majority of these actively managed funds had either poor performance and high fees or average performance and low fees, but only about 1 out of every 10 performed well on both fronts. Another reason why index investing is so effective is its low operating cost. Actively managed funds are known to charge anywhere between 1 to 2% expense ratios. This means that between 1 to 2% of your investment is deducted each year to pay the fund manager to run the fund. On a $100,000 portfolio, that comes out to $1,000 to $2,000 annually. By contrast, index funds are much cheaper given no person is actually managing the fund's performance. There isn't a person deciding which funds to buy or sell or when to buy or sell them. The fund simply replicates the index. As a result, most index funds have an expense ratio well under 0.1%. VTSAX and VFIAX, Vanguard's Total Stock Market Index Fund and Vanguard's S&P 500 Index Fund have respective expense ratios of 0.04%. On a $100,000 portfolio, this comes out to $40 annually. I'll take a $40 expense over $2,000 any day, and the real power of low operating cost really comes to play when you incorporate compounding into the formula. These expense ratios can net you or cost you hundreds of thousands of dollars over a period of 10 to 20 years. Cost matters, and the king of low cost are passively managed index funds. So you might be saying at this point, all right, I got it. Warren Buffett and J.L. Collins' two-fund index fund portfolio strategy makes sense. But how about compared to a three-fund portfolio? Great question. The three-fund portfolio is an investing approach made widely popular by the Bugleheads, devout followers of Mr. Jack Bugle's investing philosophy. And I've also talked a little bit about its benefits here in this video. Simply, a three-fund portfolio is a portfolio made of an equities index fund, international index fund, and a bond index fund. A popular Vanguard selection of these three funds are as follows. Vanguard Total Stock Market Index Fund, VTSAX. You could also substitute it for an S&P 500 fund, VFIAX. Vanguard Total International Stock Market Index Fund, VTIAX. Vanguard Total Bond Index Fund, VBTLX. You could also substitute it for Vanguard Short-Term Treasury Index Fund, the VSBSX, based on Warren Buffett's recommendation. So when we compare this three-fund portfolio to the two-fund portfolios, the glaring difference is the absence of an international stock fund. So let's talk a bit about this international fund. In a nutshell, VTIAX, Vanguard's Total International Stock Index Fund, represents close to 8,000 non-US based companies. All international companies we may have heard of, such as Samsung, Shell, and Alibaba are in it, and thousands of others we may have never heard of. By having this fund in your portfolio, you get exposure to emerging and developed market holdings, spread all around the world. Now, why would Warren Buffett and J.L. Collins exclude this fund from their recommended portfolio? There are a few reasons. One due to accounting risk. Accounting is not a sexy topic, but you have to give it to America's accounting standards. Compared to many other countries in the world, especially emerging countries, America's accounting practices are top-notch. When American companies produce their quarterly and annual financial reports, they need to adhere to strict accounting policies. Many other countries do not have the same level of transparent and strict accounting standards that's required here in the US. So what this means is that when we review a foreign company's latest annual financial report, there is a chance that the numbers reported are not as accurate because they did not have to adhere to strict American accounting standards. Another reason for excluding international funds is that the world economy is a lot more integrated today than ever before. Many of the major US-based companies today aren't just domestic companies, but they're actually international corporations. They generate a good percentage of their sales and profit overseas. For example, just look at Apple, the biggest US company based on market capitalization. As of the second quarter of the fiscal year 2021, 67% of Apple's total revenue was generated from outside the United States. At one point, there were more Chinese people purchasing Apple products than there were Americans. So the perspective Warren Buffett and J.L. Collins could have is that when you hold US-based company stocks, you already have access to the growth of the world market and are able to gain the benefit of that growth. And a final reason for excluding international funds could be due to its lackluster performance the past decade. When we compare VTSAX versus VTIAX the past 10 years, from 2012 to present, The 10-year return on international funds is pretty dismal compared to the US market. 4.5% versus 11.8% using 2022 as the 10-year mark. But this doesn't mean international funds always perform poorly. When we compare general domestic versus international index fund returns, the prior decade from 2000 to 2009, from this chart I borrowed from the Buglehead's Guide to Investing, we see that the international market outperformed the domestic market 7 out of 8 years, sometimes in margins of double digits. In this scenario, the 3-fund portfolio, which would have included international funds, would have done much better. So what does this mean when we compare 2-fund versus a 3-fund portfolio? The real key difference between these two funds is really the presence of international funds. And international funds did really well in the 2000s, whereas in the 2010s, it underperformed against the domestic market. And this is the part where I include the most common investment disclaimer known to mankind. Past performance is not indicative of future performance. What would the international market do in the next 10, 20, 30 years? No one knows. We can predict, but that is all it is, a prediction. But the more important question is, should you include them in your portfolio? I never like it when people tell me this, but it really depends. So much of it depends on your worldview and appetite for risk for the international market. If you believe that in today's global economy, US companies are no longer exclusively US companies and that they are international corporations, a 2-fund portfolio might make sense for you. There is a good evidence to reinforce this assumption. Just look back to the recession of 2008. It's most often referred to as the global financial crisis, not just a US crisis. What happened with the US housing market had a ripple effect across the globe because our markets and companies are all now so tightly integrated. Growth in countries like China and South Korea is already being reflected in US companies like Apple, who are selling their latest iPhones overseas. And another reason why a 2-fund portfolio might make sense for you is if you just want simplicity. 2 is always easier to manage than 3, and if you want that level of simplicity in your life, I believe the 2-fund portfolio would be perfect for you. Alright, so where do I stand? Somewhere in between. I love the simplicity of the 2-fund portfolio, but I also like the idea of having some limited international exposure. So the majority of my equities would be held in VTSAX when following this approach. I would also have a small percentage in VTIAX, a really small percentage until I get more comfortable with international exposure. And then I'd also be adding a little bit of VBTLX as I get closer to my retirement age. But we like the idea of ETF investing. Although they are not as stably priced as index funds, they do offer other advantages. Thank you guys for watching. And remember, financial freedom starts with an adaptable mindset. See you in the next video. Cheers!